JEPI feels like the gold standard for covered call ETFs. It's maintained its price since inception, ebbing and flowing with overall markets of course, and still managed to kick off a dividend every month. For investors looking to use a covered call strategy based on the S&P 500 but don't want to manage the trades and positions themselves, it's a pretty attractive option. $31 billion in net assets agrees with that statement. So making the claim that a new high-yield covered call ETF is better might be a tall order. The thing is, there are always pros and cons to any investment. JEPI is no exception to this. I actually had to go back to my earlier videos just to double check my initial Google search, and it's true. JEPI's yield has come down significantly as overall markets have changed. But with recent news, it feels like the markets are priming themselves for upward price action, and the bulls might be back on their way. Covered call ETFs naturally limit upside due to the nature of the strategy. That's a given. But the new high-yield covered call ETF ISPY, also known as the ProShares S&P 500 High Income ETF, has the potential to capitalize where JEPI misses out during bull markets. Is it time to consider selling JEPI and going into ISPY? Early data shows that ISPY is currently trading around $41 and JEPI sits close to $56. The last dividend paid out for JEPI was 30 cents per share. Compare this to ISPY at 48 cents per share. I know that JEPI has way more history, and 1 month's dividend isn't enough data for most of us to make any drastic changes to our portfolios. But it is interesting to note that out of the gate, ISPY pays more per share and is trading at a lower price than JEPI. Now, I was hesitant to even put this information in the video, given that things can change on a dime, especially these days in this market, and it's also not an apples to apples comparison. But for the sake of some comparison, JEPI has a dividend yield of 6.46%. And of course, assuming that the price and dividend will be the same for the next 12 months, we can draw a dividend for ISPY at 13.9%. But even so, just looking at the dividend yield isn't the best way to go about dividend investing. High yields don't necessarily correlate to better investments, especially in the covered call ETF space. So if you've been with the channel for a while, you'll know that we've covered quite a few of these kinds of investments. The more you look at these covered call ETFs, the more you realize you're really comparing options strategies. Different markets are going to have different winners. JEPI, in addition to collecting dividends from its underlying holdings, writes out of the money call options on the S&P 500 index to generate its yield. And it does this through ELNs. Long story short, they use a third party for the options, and we can't see the exact positions. We only have the ETF's results to go on and what they're telling us they're doing. According to this document, these options are written on a monthly timeline. Compare this with ISPY, which also holds individual stocks but uses options on a daily basis. Technically speaking, they are weekly options, but they expire every day. The key difference between the two funds is the timing of the options trades. So here's how I'm looking at it in the most simplified way. Imagine you buy Apple stock at the first of the month and you cannot sell it until the end of the month. You are locked into what is happening for the entire month for that trade. Now imagine you can buy Apple every day and sell it every day. It's a lot more active management in the second scenario, but could give the potential for higher rewards. I personally don't trade options, which is why I love the idea of covered call ETFs, so the options traders out there are free to elaborate more on how this all works in detail in the comment section. Thanks for the info. All that extra management is going to cost you 0.55% for ISPY compared to JEPI's expense ratio of 0.35%. Honestly, I kind of forgot that covered call expense ratios could be this low. Looking at you, yield max ETFs. So as someone who's not an expert at all this, I need more information to make better decisions. So I found this article by Jeff Benjamin from ETF.com that we referenced earlier as well. And in this article, it states that Hyman, referring to Simeon Hyman, global investment strategist at ProShares, is convinced the daily call strategy solves the issue of underperformance in bull markets, but does admit that ISPY is probably not where you want to park investors ahead of a potential market pullback. Of course, someone who works with a fund is confident in the strategy, but it is important to reference again, the first month's data is a win for ISPY. Now to address JEPI's drop in yield. Well, I'm okay with that, given that that's to be expected, given what the markets did. I would assume ISPY's yield would drop too during a market downswing. But if there's a way to capture more upside when things do get exciting again, I am interested, and ISPY seems to offer an option strategy that could do just that. So what am I doing with my portfolio with this information? Well, I hate to admit it, but I don't know the future. future. So I'm not changing my strategy at all. The only thing I'm doing at the moment is holding my dividend positions, reinvesting the dividends, dollar cost averaging into SCHD, and that's about it. I don't necessarily need the income, so I'm not too concerned with picking the right covered call ETF for the market at the moment. But I will be watching ISPY and see if it continues to outperform JEPI, and will consider investing in the future if it fits my needs or simply proves itself to be the better option. Let me know your thoughts in the comments section down below. Have a good one.